Thank you for joining me on this sort of rehashing of the blockchain presentation that we did at the end of September this year. What I wanted to do here with this video is basically go through the first 25 minutes of that presentation where we delved into how blockchain technology works, where it came about, what caused it to arise in the current context, and basically doing so by looking at Bitcoin, which is the first truly public blockchain in use, and it really provides a great foundational layer of understanding blockchain technology. And my view is that if you can understand the Bitcoin blockchain, how it came about, and how it ultimately works, you can then translate that into some of the newer applications that folks are looking into regarding blockchain, including smart contracts, real estate, recordation, and other similar things like that, supply chain management, and similar avenues that people are now pursuing with blockchain. But I think the first thing you have to understand is how the Bitcoin blockchain works, and once you get that, I think those other things come along a lot easier. So thanks for joining us. It should be about 20-25 minutes, and let's go ahead and get started. Here's our initial cover slide here. And so just, again, what we're going to talk about for this particular video is just what a blockchain is, the fundamentals of the first blockchain, which is Bitcoin, a brief look into how that was inspired, how Bitcoin and essentially blockchain was inspired by a series of events, including the financial crisis, and how it arose out of a desire to form an electronic cash system native to the internet. And I think it's really important to go into those topics to help understand how a blockchain works, because it really didn't come into play but for the desire for a native electronic cash system to the internet. So if you don't have that, I don't see really a reason why blockchain comes into existence. So for me personally, that was the best way I could understand how it works, understand why it's useful, understand what situations it might be useful for in the future. So I'm hoping it'll sort of have the same effect for you. So first, what is a blockchain? Blockchains blend together several pre-existing technologies. There's no real miracle invention, no incandescent light filament here that led to the light bulb. It was really just a combination of pre-existing things put together in such a way as to create essentially a wholly new technology. The first is peer-to-peer networks. And basically what that means is that data is distributed across multiple locations. There's no real master copy in a true permissionless blockchain. And participants who are exchanging with one another can exchange directly with one another, as opposed to having to go through some sort of third-party centralized database, as we commonly associate with traditional financial transactions, to be a bank or a credit card company or both. They're also append-only, meaning that the information can only be added to a blockchain. It can't be removed or altered once it's added. They also employ consensus mechanisms, and that's just a fancy way of saying how do we agree on the state of the chain. It's a fancy terminology for basically how a software protocol employing a blockchain gets everyone with all those disparate versions of the data, how they all contain their own separate version. It's basically a way to get those to all agree with one another in a meaningful and reliable way. They also employ public-private key cryptography, which is extremely useful for the sort of pseudonymous nature of how blockchain transactions work. There's a lot of misinformation out there, that blockchains are anonymous, and that's not true. They are pseudonymous, meaning they're very difficult to sort of unmask, but they're not truly anonymous in the way we think of it, where identities are completely hidden from anyone who's looking. And I have a little asterisk there, you'll notice, because again, there's a lot of misinformation about them being anonymous, but there was actually a very, very timely recent article in Bloomberg that quoted a United States DEA agent, and she said essentially, the blockchain gives them a ton of tools to track down people and transactions and people who engage in those transactions, and she actually wants criminals to keep using them. So a lot of the stuff you've been hearing about how there are havens for criminal activity is really overblown. Perhaps at the beginning, when Bitcoin was really just underappreciated, underutilized, criminals used them, but that wasn't for necessarily a lack of ability to track them down. It was more of a lack of desire to track them down. So with that, hopefully that takes away some of your initial skepticism off the bat, because a lot of people have heard that these are criminal havens, and it's not really very true. So with that, we'll go into straight into how the blockchain works. And we're going to look at Bitcoin because it's the first blockchain. And you'll notice I also have another asterisk there, and that's because I did what I hate the media does, and that is use a tangible coin as a representation of Bitcoin. But just so you know, it's not a real coin. It's a wholly natively digital asset. It's basically just a series of signatures on a long chain, but it looks nice, so people like it, and I used it too. In order to understand Bitcoin, we have to really probe a little bit and wax a little philosophical onto the concept of money and accounting generally. It's a question that we don't often ask ourselves, how our money works and how our accounting system works. But it's sort of just self-evident to most of us, but we really haven't really considered exactly the fundamentals of money. And in order to understand Bitcoin and the usage of blockchain on the Bitcoin protocol, I think it's useful to talk about how it works at a basic level. So really all money is just a ledger. It's simply at its core, it's a system of accounting. Paper notes, coins, commodities, stocks, bonds, currencies, and all those physical representations of that accounting system. And they could otherwise be represented as assets and liabilities on a ledger. Today, digital balances replicate that physical representation of the ledger. Now, money is exchanged effectively in one of two ways. Person to person, which is how it's been for the vast majority of human history, and then also, more recently, electronically. I would say the first electronic transmissions of money came over telephone communications and things like that. But today, the much more apparent, much more utilized version of electronic exchanges of money and value go over the internet. So when the internet first came on the scene, it was shrouded in a lot of mystery and misinformation, but also a lot of potential, not unlike blockchain is today. So I just want to quickly show this 1.5-minute video of the host of the Today Show talking about the internet in the early 90s. And I just want to have you kind of look at it and compare and contrast it with how blockchain's talked about today.
56 pass, I wasn't prepared to translate that as I was doing that little tease.
Oh, that's
that little mark with the A and then the ring around it.
At.
See, that's what I said. Mm-hmm. Katie said she thought it was about.
Yeah. Oh.
But I'd never heard it. I'd never heard it said. I'd always seen the mark, but never heard it said. And then it sounded stupid when I said it. Violence at NBC.
I heard something big fight up in the lunchroom the other week.
There it is. Violence at NBC, GE.com. I mean...
Well, Allison should know.
What is Internet anyway?
Internet is that
massive computer network.
The one that's becoming really big now.
What do you mean? That's big. How does one? What do you write to it like mail?
No, a lot of people use it and communicate. I guess they can communicate with NBC writers and producers. Allison, can you explain what internet is?
No, she can't say anything in 10 seconds or less.
Oh, Allison will be in the studio shortly.
What does it mean?
It's a giant computer network made up of started from.
Oh, I thought you were going to tell us what this was.
It's like a computer billboard.
It's not in it. It's a computer billboard, but it's nationwide, and it's several universities and everything all joined together.
Right.
And others can access it.
Right.
And it's getting bigger and bigger all the time.
It came in really handy during the quake. A lot of people, that's how they were communicating out to tell family and loved ones they were okay because all the phone lines were down.
I was telling Katie, and I've been
talking... But you don't need a phone line to operate internet?
No.
So as you can see, there's a lot of confusion about what the internet is, and we look at it now and it looks sort of funny because it's really hard to imagine a time when we didn't all fully understand the internet and have a great deal of knowledge about how to operate it and what it's used for and what it can't be used for. But I really like that video because I think it's very timely with respect to this blockchain discussion, because we really do have a lot of similarities that we experienced in '94 with the internet, we have those same experiences going on now with blockchain. So with that backdrop, we can now look at how blockchain arose out of the growing acceptance and use of the internet, and how it's essential for a native electronic cash system for the internet. Initially, the internet was a great communication tool, but it couldn't do a whole lot else. In order to maximize the internet's potential, there needed to be a way to securely send money over the internet to engage in transactions. Early on, many tried a native electronic cash payment system, but they consistently encountered what was a seemingly intractable problem known as double spend. And that's where, it's essentially a form of counterfeiting. It's where one person sends the same money to 2 different places or 3 different places, but they call it double spend, so 2 different places. And if you think about it, that is really how most electronic communication occurs, and it occurs very benignly. There's not a whole lot of issue with it. If you send a copy of it, if you send an email to a colleague, then they won't get the original email; they'll get the copy of that email. If you send an attachment or put something on Dropbox or a share file, you're not sending the original, you're sending a copy of it. And that works reasonably well for most of those things. In fact, you like probably sending a copy because it's nice to have your own copy as well. But for something like an electronic currency, that way of doing things is absolutely fatal, because the currency would ultimately inflate itself into non-existence, because every time you sent money, it would copy itself and you would not lose money. So it fundamentally destroys the underpinnings of how money works. Over time, when it became more and more apparent that a native electronic cash system wouldn't work, it was solved essentially piecemeal by centralized intermediaries like banks and credit card companies and clearinghouses and things like that, PayPal. And essentially it reinserted the intermediaries back into the system, and they took care of the issue of drawing down person's funds, adding funds to a person who's receiving cash, doing all the background identification and things like that. And this led to the internet as we see it today. It led to things like eBay and Netflix and Amazon, and really created the robust internet experience that we have today. But then came the 2008 financial crisis, and this exposed systemic gaps in the financial system. And for many who had continually worked on the electronic cash system, it was a confirmation of the usefulness of electronic currency. And it was at this time that Bitcoin was actually released into the public, and it solved the problem of relying on centralized intermediaries to participate in the economy. It delinked currency creation and manipulation, importantly, from banks and national governments and international bodies, as well as organizations of cooperative banks. And this was, at the time, remember, 10 or 11 years ago, 10 years ago, this was becoming much, much more desirable, because people had utterly lost trust in the financial system and governments that the financial system supports. It also promised to allow greater participation in the world financial system for less. So in the United States, there's approximately 7.7% of our population is unbanked, meaning they don't have access to or use a bank. 17.9% are underbanked, meaning they rely a lot on pay cards and things like that. They use a bank, but very, very little, and their day-to-day lives don't interact with the bank. And worldwide, this number balloons up to 2 billion. So I always say, if you can convince an American or a Western European of the usefulness of Bitcoin, then you've made it, because for a huge, significant minority of our global population, the usefulness of a native electronic currency that doesn't go through banks is self-evident. And I think as we move on, as we continue learning more about how this technology works, that self-evident nature of it starts seeping into even Western cultures who have relied upon a traditional banking system their whole lives and have never known anything else. But it's much more of a process. Lastly, Bitcoin capped the supply to in an effort to curb inflation. And again, because the financial crisis revealed that the ability to print money at will, essentially, undermined currency valuation. And so that was something that they wanted to avoid with it. So let's go into now how one sends funds on the blockchain. So as you can see here, I have a pretty rudimentary slide supposed to sort of demonstrate how each individual person on the blockchain has a copy of the ledger. As you can see, John, Jane, Sally, and Steve are our experimental blockchain participants. They each have a copy of the ledger, and it's all updated accordingly, and they all share the same copy. Share the same figures on their own individual copies. So let's say John wants to send 5 Bitcoin to Jane. Basically, all that really needs to occur on his end is he needs to initiate the transaction by sending from his address to Jane's address, which is open and public and available. It wouldn't obviously be a name. It would be a string of numbers and letters, but nevertheless, you'd be able to know who you were sending it to. So John initiates that transaction and announces it to the entirety of the network when he does so that everyone can see that John is sending Jane 5 Bitcoin. It's pretty easy to verify because of the open nature of the blockchain. It's pretty easy to verify that John has enough Bitcoin to send, that he won't be overdrafting, because you can see he clearly has 10, and everybody on the chain who's participating in keeping a copy sees that he has 10, so he's not overdrafting, so the protocol won't kick the transaction back. In the event that John were to send too much, it would be sort of like an overdraft, except in this situation, unlike a traditional bank where you maybe find that out after the fact and get penalized, in this case, the transaction simply doesn't go through because everyone can quickly see that he doesn't have enough, so the protocol will kick it out. But why does this work? That's the big question. How can someone, let's say, who hasn't been on the chain from day one back in 2009, why should they trust that everyone's updated properly, no one's double spending, no one's behaving dishonestly? What guarantees that, or works to guarantee that in this ecosystem? And the answer is proof of work, and that's the consensus mechanism that I talked to you about a little bit about earlier. There are different types of consensus mechanisms, but for the purpose of this video, and since we're focusing primarily on the Bitcoin blockchain, proof of work is the version that we're going to focus on today. And so what it essentially does is it secures the integrity of the chain, and it secures the veracity of the chain for all the participants to be secure in the fact that the version that they are looking at hasn't been messed with or tampered with in any way. And proof of work essentially is little more than an incredibly difficult puzzle to solve. Now, I do feel sort of like I'm paying it short shrift by just calling it a difficult puzzle, but in essence, that's what it is. And all that really has to occur is computers must guess potential answers to solve the puzzle. The answer of the puzzle is entirely random every time, and there's no shortcuts. You can't find a way to more quickly guess the answer. It's only capable of being done through just brute force guessing, which incidentally computers are very good at because they can perform many operations almost simultaneously or consecutively. So it's specifically tailored for computers, but again, it takes a lot of time because you're going to have to guess a lot of times to finally arrive at the proper answer. And it also requires quite a bit of energy because the act of doing those computations absorbs and requires significant energy. One way to think about this is kind of like a very sophisticated and dynamic Rubik's Cube. So, for example, when a computer solves the cube, it'll ping the network and let everyone know, this computer has solved the puzzle, solved the cube, solved the algorithm. And at that point, all the computers are going to verify that this solution is correct by essentially putting the solution back in to the algorithm and seeing if it spit out the correct answer that the algorithm was requesting. And this is very much like essentially showing your work on a solved Rubik's Cube, right? Rubik's Cube is very difficult to solve if you're attempting to solve it without any sort of shortcuts or anything like that, it's very difficult to solve. But once you've solved it, it's very easy to show everyone that you've solved it. You can just have them look at the colors and make sure they're all aligned, and everyone would very easily be able to see that you've solved it. So the interesting thing about Bitcoin proof of work scheme, though, is that the difficulty of the puzzle is dynamic. So, and this is to account for the computing capacity of the network. So the protocol assumes that more and more computers will join the network to help solve these puzzles. I'll explain why here in just a minute, but it assumes there will be more participants on the network. And it also assumes that computing power changes over time and gets much, much better over time. I mean, if you think just back to your computers from 5 or 10 years ago versus your computers and cell phones now, it's very easy to see how much more sophisticated they are. So with more sophisticated computing power comes more ability to guess at these potential answers, more computing capacity to guess at these potential answers. So they have to increase the difficulty such that even though more and more computers are being added and computers are becoming more and more sophisticated, it will still average out to be about 10 minutes for the solution, or for the time required for each puzzle solution. And this is so the chain will update regularly and confirm transactions in a predictable way, and it helps ensure that the network and that the ecosystem, the Bitcoin ecosystem, is reliably updated and secured on a regular basis. So once the proof of work puzzle has been solved, then everybody can update. Then everyone can be secure because the person who solved the puzzle took the time to solve the puzzle, took the energy required to solve the puzzle, bought the computing power necessary to solve it, and in so doing, it permitted the chain to be updated, because you can't update the chain without also solving the proof of work puzzle. Otherwise, people will not accept an update because it has to be accompanied by a proof of work puzzle. So once that happens, everyone can be secure in the fact that the chain is legitimate, that the transactions have been verified, and then it will link back. Then that block is essentially sealed and can no longer be tampered with, because it links back to the remaining parts of the chain, which are all linked together through that same algorithm puzzle. And if any bit or portion of the chain is altered for some reason, maybe next time or a few times down the road, it will, because they're all linked together, and this is the importance of the blockchain aspect, because these are all linked together, it will throw the entire network into disarray if people were to accept it. So what happens is, if someone tries to alter a portion of the chain from further down the line, nobody's going to accept it, because it will realize now that all these blocks, every 10 minutes or so that you've had for however long in between the altered portion of the chain and the current time, all of those now will be totally different, and they will not register properly. So no one's going to allow that to happen, and that's why you can be sure that the chain is static once the blocks have been created. So, and that's why they say blockchains are append only, because you really can't change anything below, and the data is very secure below, and each block that goes on, that gets added on, secures the block before it more and more. So the question really then becomes, why do this proof of work puzzle, right? Like, it costs a lot of money, thousands of dollars worth of energy and computing machines to attempt to solve one of these puzzles. So what's the point? It breaks down into basically three things. First, it's the only way to alter the state of the chain. As I said, it's the only way to append the chain and make a new transaction happen. The other thing is, it solves the problem of double spend, because the big issue with, I mentioned earlier, the big issue with digital currencies is that people might fraudulently use the same digital currency in two places, the same exact one. And this one proof of work protects against that from happening, because of all of the energy that is required to solve the puzzle and the sheer mathematical improbability of actually being the one to solve it, because there are so many participants on the network also attempting to solve it. the sheer energy and the improbability of being the solving party makes it very, very, very difficult to also then fraudulently alter the transaction such that you can spend that same digital currency in another location. And you may have heard at this point about something called a 51% attack, and that's basically where one actor or group of actors controls enough computing power to basically have 51% of the computing power of the network. That's when the network becomes vulnerable to what's called a 51% attack, because if you can get 51% of the computing power, then you can effectively say, okay, I'm going to be able to solve puzzles significantly more often than the rest of the network. I'll be able to trick all the other participants into my version of the chain, even if it's not an honest, non-fraudulent version. The issue with that, though, especially as the Bitcoin network gets bigger and bigger and bigger, the issue with that is it's incredibly expensive. It's about, the last estimate I saw was it maybe costs about $20 billion to overwhelm the network with, in terms of energy usage and actual computing machines, the cost of computing machines. Roughly $20 billion is probably more expensive now, as I looked at that statistic a while ago. So it's incredibly difficult. But there's also this sort of game theory, third aspect of the why of proof of work that prevents against even someone getting, let's say someone even did get 51%. There's a bit of a game theory aspect to how proof of work works. And this is where the block reward comes in. So the block reward is your reward for solving the puzzle and securing the network. So if you can solve a puzzle and it's validated and accepted by the chain and all the other participants on the chain, right now you get a reward of 12.5 Bitcoin for your efforts, plus some minor transaction fees. So roughly 13 Bitcoin, maybe a little bit more at this time, which equates to nearly $100,000, something like $90,000. And that is not insignificant. And that's the reason why people race to solve these puzzles and race to verify the network, because they get a lot of Bitcoin if they happen to be the one that solves the puzzle. And it also has the side purpose of releasing new currency into the market on a predictable, regular basis. So the block reward holds both of those two functions, and it is the sort of economic incentive to behave honestly. So again, back to whether, that instance where maybe someone does in fact get 51% of the network such that they can defraud the network if they wanted to, it makes a lot more economic sense not to trick the network into your fake double spend transactions, but to just go ahead and honestly solve puzzles. Because if you can do that, you'll be able to acquire a significant amount of Bitcoin, and at that point, you have a very large vested financial interest in securing the network honestly, and because you want your value of Bitcoin to go up. And so that basically is the final piece in what secures the blockchain and final piece in illustrating how blockchain works. So just to kind of quickly review, as I said at the very beginning of all this, the blockchain blend several existing technologies. First was peer-to-peer networks, which were the instances where people can exchange directly with one another electronically rather than having to go through some sort of centralized intermediary like a bank or a Western Union or things like that. They're append only, and that's facilitated by what are called consensus mechanisms, just like proof of work, as we just saw, that sort of limit a person's ability or a group of people's ability to alter the state of the chain. It basically makes it very difficult to alter the state of the chain, and it also simultaneously makes it almost impossible to go back to a previous iteration of the chain and change some sort of information on it. And then lastly, and we only talked very briefly about this, but lastly, they employ public and private key cryptography, and that's how you have this sort of pseudonymous structure of participants on blockchains. And I don't think we really need to get into that too much at this point. And also you'll see here why use a blockchain. This is where our presentation continued from last month, but I'm not going to get into that at this point either. I think we've covered enough for now. I hope you've been able to get a foundational layer of how blockchain works, how it came about, and hopefully how Bitcoin uses the blockchain and why it was integral into establishing this electronic cash system that's not linked to any sort of centralized party. We'll be doing some more presentations specific to practice areas and how blockchain will or may interact with a specific practice area. And we'll be sure to get the schedule out to that. If you have any questions, I'm always around, happy to discuss. But thank you very much for listening. And I appreciate you giving me time to talk about this very interesting topic.